Hey, what's up, TrustEngine community? This is a community dedicated to innovation in lending. We want to interview people. I want to interview people outside the industry, in the industry. My name is Dave Savage. I'm the Chief Innovation Officer of TrustEngine, and I am interviewing the CEO, Charlie Pratt of Homebot, an awesome innovator in lending.
Awesome. Thanks for having me, Dave. Really appreciate it.
Yeah, no, I'm looking forward to this conversation. We've had a long history of our two companies. I've always been very proud of the innovations that we've done together. And the thing I'm most proud about what we've done in the past is how not only are we innovating for the C-suite in the mortgage industry, we're really helping loan officers. I mean, they're getting tremendous value, and we're helping consumers build wealth with real estate more efficiently in a very unique way. So I love this partnership.
Absolutely. Us too. Yeah, it's been a super valuable one for our customers, and looking forward for more to come.
Yeah, well, I'm looking forward to hearing how you say you've unpacked a bunch of public companies in lending. We're going to center this around Rocket. Like what is the data, what are the results, and what are the best practices? So I'm looking forward to this conversation around that. Before we do that, just for anyone who doesn't know your backstory, know a little bit about, your role. I mean, obviously you're CEO, but what does that mean at Homebot? Give us a little backstory and a little bit about your role, and then let's get into the topic.
Yeah, and Dave, I'll go way back for a second because I think it's related to what we're about to talk about, which is, data intensive, unpacking some empirical trends in retention. And well before I got into software, I was equity research analyst with Bank of America, working for an analyst by the name of Ken Bruce, who is most known for calling the downfall of Countrywide before it was popular to do so. And so I was around him and covering a lot of fintech companies, consumer finance companies, and selling our trading ideas to institutional investors and hedge funds. So, now that I'm in software, I still have a passion for public trading and data and markets, which I think kind of brings some, a unique lens on the space and what we're seeing and how people are packaging their information for their investors. But fast forward to today, CEO of Homebot, and just by way of quick background on Homebot for those who aren't familiar, our mission is to connect people. When I say people, I mean loan officers and real estate agents with their clients. We connect them to make more informed home ownership decisions together. And we really mean together, right? It's for consumers, it's a place where they can go. It's a trusted environment to learn about their home, as an asset, and really making smart decisions with that asset. And for customers, it's a place where they can stay in touch with all their clients who are engaging with our product at a 50% rate. So we're, similar to you, like we really take a lot of pride in unleashing loan officers and real estate agents to be advisors and to spend more time advising and less time prospecting. And our product is one of the ways, and same with your product, in which they can achieve that.
Yeah, well, I think this is a theme both our organizations have, and for any executive, listening to this, for any loan officer listening to this, I think, both our organizations are transformational in lending. Like our mission is that all borrowers can achieve financial freedom. And I know, in a marketing perspective, you guys talk about building wealth. And I do think, the future of lending, I'm going to ask Charlie at the very end, what does he think things will look like in 2025 and 2030? But at the end of the day, I think that, the way the industry works, it's very transactional. It focuses on, one loan. Let's face it, most lenders do not focus on the lifetime value of a consumer. They don't drive retention efforts, and they're more focused on the transaction than they are about the overall long-term financial freedom of that consumer. And I think both of our technology platforms together really do that. I mean, first of all, I think they create financial freedom for the consumer. And I think that if companies, do it right, and loan officers do it right, it creates financial freedom for the professional and the lender as well. So let's start getting into it. So before I ask you specifically to break down Rocket Mortgage retention and best practices, let's just talk. I want to hear your opinion on why is retention such a high priority, and any strategies you want to share within that.
For sure. Yeah. So I think for starters, and this might be a bold claim, and I'm really curious to get reaction here from your listeners, Dave, but I think a lender's retention rate is the single most important indicator for future value creation for their business. And when I say lender, I'm talking about, you know, the mortgage company. And that's for a few reasons. I think the first reason is that retained revenue is so much more profitable than new client acquisition, right? I think you hear a lot of numbers thrown around. Yeah, some as high as 5 times as profitable compared to new acquisition. But even if it's 2-3 times, I mean, it's an extremely efficient source of recurring revenue for these businesses in which transaction cycles are so long. And the second reason why I think it's really important is due to the compounding nature. That I think, again, given the length of the transaction cycle, the compounding nature of retention often gets overlooked. And what I mean by that is, you know, say I double my retention rate. That means after the first transaction, that consumer is, you know, on an expected value basis, twice as valuable to me. But on the third transaction, 4x, 8x, et cetera. So you get this kind of exponential growth by really focusing on retention. And that this next part's the most important piece, which I think by focusing on retention and the customer experience, right, and really being an advisor throughout the length of their home ownership journey, it unlocks every area of your business. That if you're really focused on, you know, best in class advice and relationships, that's going to lead to more referral business, better brand recognition, and those results compound. So those are kind of the 3 areas as to why I think it's one of the most indicative metrics of long-term enterprise value creation.
Yeah, no, I absolutely agree with you. I'm going to just throw on a few other considerations. And I do want to throw it to anyone watching this, whether you're watching our YouTube channel. I'm sure we'll post this on LinkedIn and other social media. Anything we miss on this, like all the reasons why retention is not the #1 metric and all the reasons why your database should be your single biggest priority, is first of all, it's also great for loan officer retention. Like if you at an enterprise level truly have technologies deployed, you've institutionalized those where the loan officers that work there get, you know, they get more loans out of a database. Like if you can do that, you recruiting value, retention value for your loan officers. For all the loan officers listening to this, if you literally run, you know, like just this incredible mortgage practice at the LO level, it's a recruiting tool for realtors. Let's face it, like, you know, realtors are probably worse than the mortgage industry at retention, but when you build a retention mortgage platform, you are more attractive to the most successful realtors, and you're going to retain them better. You're going to recruit them better. And then I think, you know, dating back, because I was an originator once upon a time, and there were a few times in my career where I thought about, yeah, I need to get in the, you know, life insurance business because they, you know, it's like, it's residual income. Yeah. Or, oh, I need to get in the asset financial planning, residual income. And that's where I'm going to close it with you guys, is that this is the holy grail. Like if you build a mortgage practice at a company level, at a loan officer level, like it really becomes a residual income business. And I'm just going to close with, and the job is a lot more fun. Like you have a much better day at the office when you're killing it with retention. Anything you want to add on to that, or any thoughts to that?
No, I think that's awesome. I think, Dave, I'm curious to get your views too on your reaction to framing retention as one of the most important metrics.
Let's just say #1.
Let's go right to it. All right, I love it. I think it's hard to wrap your head around that in an industry where oftentimes homeowners wait 7 years before, you know, taking cash out, doing another transaction, and staying in touch with somebody to earn their business 7 years from now takes a lot of discipline, given it's so far kind of delayed gratification. It's easy to say, it's really hard to do in practice.
Well, also, I think both executives and loan officers, they're hunters. You know, they're like, I want the new relationship. I want to recruit the new loan officer. I want to recruit this, and there's so much attention on hunting for new that, let's face it, retention it's a long game. It's a farmer's game. And yeah, so let's switch to Rocket, because I'm personally super curious to hear, because you've read all the public information, not only on Rocket, but a number of other public lenders. So, let's just start with data
Yeah.
and then get into best practices. Like what's the data as you unpack this stuff?
Yeah. So let's start with a data point that I hear thrown around a lot, which is that our industry's retention rate, right, mortgage company retention rate, is about 20%. And hearing that time and time again kind of sparked my curiosity to go see what is actually out there and publicly reported. And that number requires a couple disclaimers, which is the industry average is about 20% for mortgage servicers and for refi business. So that 20% stat is refi specific. And they're, call it 8 public mortgage companies that have kind of a mix of retail and servicing businesses. And I found 4 of them that reported retention rates in a way that, we could roughly compare them to each other. The other 4, I had a really hard time finding a reported retention rate or finding a methodology that allowed us to compare across those businesses. And Rocket is an interesting one. I think, they, in every single one of their presentations, investor decks, public reports, SEC filings, retention is really front and center. And the way they report their retention rate is interestingly more similar to a software company, in that they're saying their retention rate is about 90%, which seems crazy high for a mortgage company. Crazy high, right? And the way they're looking at it and defining it is they're retaining 90% of every single one of their existing customers in a given year. Whereas other mortgage companies say, of those past clients who transacted, we're retaining, 30, 40%. So really, to be able to compare Rocket's retention rate to how everybody else in the mortgage industry is reporting it, you have to take 90% times 90%, 7 times over through the length of a transaction cycle, which puts you kind of right in the 40% range, which is really similar to, some other best-in-class mortgage companies like Guild. So we have this kind of inconsistency issue when we look at retention across the industry, but I'll pause there.
Yeah, well, I was trying to drill down on that myself to okay, 90, I think they claim 92%. I'm like, how is this even possible? And I had spoken to a number of folks around it, and it also has to do with the number of different products that Rocket has, where they're, they've got, they're very aggressive with credit lines and different types of debt solutions. Whereas most of the, the public companies you're going to call out, they're pure play retails, lenders and loan officers, and they're not the same type of business model. So I think it also has to do with the product. You did call out Guild just now. They're a mutual client of ours. They're a great TrustEngine client that, we've had a lot of success with. How would you compare Guild to Rocket, and if you want to call it any other companies, I'll leave it to you on who you want to mention.
I'll just comparing kind of Guild and Rocket, and this is, based on my crude analysis, but I would say their retention rates are probably very comparable. And Guild put so much pride and focus and energy into relationships in their retail business, right? They're very focused on being a part of the community and building their business in a way that lends themselves to strong realtor relationships and, past client relationships. But I think for most people, if you were to ask a random sample of 100 people in the industry who has a better retention rate, they go with Rocket, given, they're quoting 90% and they've got all this brand recognition. And so I think it's really interesting to contrast the two once you kind of normalize the retention rates and say, look, they're pretty equal. And you have Rocket spending billions of dollars in marketing, and Guild, who's really focused on executing a relationship first strategy.
Well, let's face it, they also, they're big, clients of ours with a lot of loan officers that are, black belts and grandmasters at delivering advice over price. And I know they're a client of yours. They're a good adoption client of yours as well.
They are. Absolutely. Yeah.
Well, maybe we can say we get the credit for it, like it's the 1-2 punch of TrustEngine and no, Gemma and Barry, just kidding. I know we're a piece to the puzzle and there's a lot more to the success, but I do want to, I hope everybody right now, one, like write down these benchmarks, and then two, what is your retention rate? I mean, if you are a C-level executive, what is the retention rate? How does it compare? So you're saying these guys, forget about Rocket and the 92%, that's not a benchmark. You're saying as CEO of Homebot, like 40% is the number that you should be benchmarking yourself at. Is that right?
40% is absolute best in class. Absolute best in class. And I would say, Dave, for how most of us think about retention and mortgage, Rocket has about a 40% retention rate. Meaning of their past clients who are transacting this year, Rocket will retain roughly 40%.
Okay. Now let's go to, kind of the delineation between refi and purchase, because there is a real difference between retention of, let's call it a portfolio and refis and purchase. What are the benchmarks of excellence between those two? And what are why do you think there's such a difference between the retention rates?
For sure. So again, limited data. So we're working with a small sample size, but I think if I had to guess at the industry average purchase retention, just by looking at a few companies, be around 10 to 15%.
Yikes.
With refi retention, more like 50%. And that's a pretty big gap between refi and retention. And I sat with that for a little bit, and I think, again, would love to hear the community's reaction. I think there are three main reasons that lead to the big difference between purchase retention and refi. And the first is loan officer turnover, right? Given how relationship-oriented purchase business is, the industry turns over about 30 to 40% of loan officers every single year. And that's data from the MBA and Strathmore that starts in 2002 and looks at turnover rates going all the way to 2020. Over that 18-year average, turnover was, I think, 38%. So if purchase business is heavily dependent on relationships and you're turning over 38% of your business in terms of your retail loan officers every single year, from a lending company perspective, it's brutally hard to retain purchase business. Whereas refi, and this is another interesting point of data, consumer direct lenders have pretty high refi retention. Right? And I think we can all, guess as to why that is, right? Especially if they're in the servicing portfolio, so much data to get in front of those consumers, and it's very rate dependent and time dependent. So turnover was the first thing. The second, I would kind of summarize as the real estate agent position in the funnel. Whereas if you look at NAR's 2022 survey of buyers, most people reached out to a realtor before they reached out to a lender, right? So the realtor is still in the driver's seat in our industry in terms of determining, which referral partner they're going to bring in. And so if you're a loan officer and you've got a realtor relationship, say that realtor has, 4 other loan officers who they're loyal to, you have a 25% chance of winning that referral. And then the third thing is something I hinted at earlier, which is just the length of time between transactions in this industry is 7 to 10 years. And there's a lot of discipline and skill that goes into maintaining relationships at scale over a long length of time. Especially given what you said, is people are hunters, and having the mindset of delayed gratification is really hard when people are so focused on the next transaction.
Yeah. So for anyone listening to this, I want you to, write down for yourself, what do you think the top drivers of that difference are? Anything we didn't mention in this conversation, I would love comments down below, whatever channel you're watching this in. I'm not going to pile on a lot there, other than I just don't think you can underestimate this, the the hunter mentality in purchase business. It is a hunter mentality, both at the top. Just let's face it, guys, the industry is transactional. Most of the technology in mortgage tech is designed to manufacture a compliant, profitable loan that you can sell in the open market. Like that's what it is. And something that makes our two technologies different is, we are designed to help consumers achieve financial freedom with real estate and to help loan officers do that. And I don't think there's enough emphasis on, one, making sure you have that in your tech stack. You've got a really thoughtful retention tech stack, which, I'm proud to say, TrustEngine, Sales Boomerang, Mortgage Coach, and Homebot are just absolutely essential to optimizing retention. And I just think it's still, but again, just investing in our technology is not a competitive advantage. It's institutionalizing them. It's getting it to where your loan officers are hunters and they're farmers, and they're leveraging this tech in super consistent and effective ways. So before we flip the page to just like, let's break down best practices. Like, hey, I've got things that I think are best practice. You have things that you think are. Anything else you want to say around this chapter of the conversation before we move on?
Just a question I'd like to toss back to you, Dave. I mean, you talk to so many top producers, whether it's the TrustEngine or Mortgage Coach channel. I mean, how many of the top producers you speak with you think could quote their retention rate?
So few. I mean, it's just so rare, even among the best of the best, that they will do that. They know, more of them know their conversion rate.
Right.
Like when I interview the best of the best loan officers, they know how many leads they got. They know what their conversion is. And then retention is, it's a low number. I mean, it's less than 1% of the loan officers in America, and it's less than 30% of the best 1% know it. And every time I meet, and I have, conversations with people that, I know a lot of $100 million producers. I've interviewed a lot of them. Yeah. I talk to them about, like, what, you're leaving so much on the table. And I go through just a 5-minute conversation on retention. And like, there's always like, there's another 100 loans a year. Like, we're not talking like, oh, I'm going to close an extra loan here and there. We're talking about individual teams that are leaving hundreds of loans on the table because they're not, resourcing to it. Like, hey, if you've got thousands of customer, 1,000+ database, like, resource to it. And that means make sure that, it's in Homebot, make sure it's being monitored by Sales Boomerang, making sure you're giving advice. And if that means you have to get more headcount around it, get the headcount around it, because it will, even in every marketplace, even a purchase marketplace like now, you'll get an ROI on it.
Absolutely. Yeah. What you were just saying reminds me of something that has kind of caught on the real estate side of things, which is this concept of, homeowners under management. Much like, if you're an asset manager, assets under management, like that is your bread and butter. And that is something to nurture and pay very close attention to. But, you saying that 1% of loan officers could potentially recite their retention rate. I think part of that is most lenders, most lending company leaders would have a hard time, right? They're probably, 40 to 50% who really understand and are measuring and managing their retention rate. So I think there is this awareness.
And I'd push that one step further. At a company is not all, I mean, there's someone in almost every company that knows the number, but the whole executive team should know it. And it should be measured. By the way, there are companies where they, everyone in the C-suite knows it, and they have the intelligence and the tools all the way down. And let's just say, guys, those are the companies that have the best retention rate. So, measuring what matters. I use the term mortgages under management a lot, just because, and at Sales Boomerang, we call it RUM, records under management. But I mean, those are all just really important concepts. And I think it's a good transition into strategies and best practices to optimize retention. So what are what are some of the first things that either one you want to call out from some of the research you've done of these public companies, or things you want to call out as, CEO of Homebot? What are your best practices?
The number one tip, which is very related to what we were just talking about, is start by measuring it, start by tracking it. And, as the late management consulting guru, Peter Drucker, says, what gets measured gets managed. Right. So if you're not measuring it, start there.
And all the way down the organization from top to bottom.
Absolutely. And I think it's important to say that, you don't have to be a servicer to measure your retention rate. And it's most common right now for those who have a servicing practice to measure retention. As an individual loan officer or a branch manager, regional manager, without servicing, you can measure your retention rate. So start there. And, second, I would say hold yourself and your team accountable to it, and really understanding the trends and why they're moving the direction they are. And third is, I'll call this one disciplined relationship building. And Dave, you're good at advising people to kind of check in with people using kind of the TCA as a tool to kind of understand their current situation. Whether it's every 6 or 12 months, have a quick touch base with people in your database. And be proactive, right? Because usually by the time you find out someone's intent, it can be too late. So really be proactive, whether it's you or someone on your team, in understanding your client's position and where they are in their journey. And the last one I'll leave people with is to kind of be a true learner and be really curious in this process. So as you're measuring it, holding yourself accountable, and building disciplined relationships, when you see that someone goes elsewhere, as they inevitably will, call them, understand why they went to a different lender, what you could have done differently. Was it an awareness gap? Did they forget about you? Right? There's a whole lot you can learn there. And I think of, a lot of software companies really trying to dissect, at a much smaller scale, given the less transactional nature, exactly what the motivations are of their customers, whether they stick with us for a long time or they go in a different direction.
Love all those things. So I'm just going to put an emphasis on the measure, and measure, all the way down to a loan officer. And for all you loan officers, you can measure this monthly. How many records under management do you have? How many loans did you do last month? And then times that by 12. And that is, if it was 1% and you got a 12% annual pull-through rate. And then now in a year like now, it's not a refi market. So the constant prepayment rate is not high. That'd be a pretty good number. But measure everything. Make sure that you're monitoring all your data. We see a lot of folks that we're going to manage our portfolio or our past customers. And, the people that we see that get the highest ROI on, TrustEngine, they're managing TBDs, rigorously. You want to know when you're getting double apped, and you get an alert. You want to know when FICO scores are going up. You want to, the more data you monitor, the better, and the more you'll create habits around your sales force around that. Needs-based contact strategy. So we're really hot on, in the mortgage industry, everyone knows speed to lead is the key to conversion. And we think that that's not enough going forward. At TrustEngine, we think it's speed to need. And what we mean by that is not only are you the first one to call the customer when they need you, or the first person to, email, text, but it's based off a known need, like an equity alert. Now I am with you. Annual reviews are a great, just, if you want to optimize retention, you want to, lose the fewest loan possible, just like a financial advisor, have a rhythm around, hey, every year, let's do a check-in regardless of needs. But let's making sure that throughout the course of a relationship, you're reaching out when there's a need. And some needs that people don't think about a lot, when someone has a kid that just graduated from high school, that's a need to call up that family and start talking about, hey, did you know that your kid could house hack? buy their first home and pay for college education, or they could buy a duplex or a triplex. We need to start getting to the consumer with ideas around how to build wealth with real estate based off of needs. And life alerts, life alerts, credit alerts, debt consolidation alerts. Those are all key. And then the last one I'll put is reach out with value. You know, when you can turn technology and data into consumer value, which I think at Homebot, I mean, that is your product. You know, it is a marketing tool, it is a retention tool, but it has tangible consumer value for a homeowner. And we do the same thing at Mortgage Coach. Like when you reach out with a need, like we're not just like, hey, you can get a loan, here's your rate, here's your payment, here's your cash to close. It's like we're reaching out and showing, hey, did you know you could pay off your home 10 years earlier? Did you know you could achieve financial freedom faster? So I think it's super important that, you know, the lending industry, you know, adopts those things. What are your thoughts on the things I just shared?
I love that. One quick reaction is that you're talking about speed to need, and it makes me think of, you know, how the industry, I think, is really trending from being a little bit reactive to these needs to going further and further up the funnel and trying to anticipate these needs.
Right.
And you know, the annual check-in is one way to do that. But products like, you know, TrustEngine and Homebot, and really, you know, providing consumers with a space to interact on their terms that can give you a good sense for what they're thinking at any given moment, leads to warm conversations, leads to advice that's highly personalized. And that's the other thing too, is I think, you know, I think gone are the days of you know, drip campaigns, right? Like we all have
funny
boxes. It's it has to be personalized at scale, and those who do that, I think, are going to be really successful.
Yeah, no, that's a absolute pillar here, is that you know, we really do think, and here's the thing I think lenders don't realize, is that not only are a lot of those types of campaigns noise, but it's hurting your brand. Because now when you do send something that's not noise, you know, you're already in the spam folder, you're already the noise machine. And so, you know, the concept of delivering things of, you know, timely needs-based value, it not only gets better results, but it actually helps your brand, I think.
I do too. Dave, really quickly.
Go for it.
Speaking of, you know, delivering things that are kind of personalized at scale, I think Rocket, speaking of them, they're a great example of acquiring Truebill, which I think is now rebranded to Rocket Money, and helping people manage their recurring subscriptions and their financials in a way that really adds value to their consumers at scale.
Yeah, good call out. Everybody lending, you should check that out, because it is a great example in a modern way. It's a problem that we all have now in this, you know, how many different subscriptions do we have to watch movies and, you know, just do life? It's a subscription economy, and they saw the problem, they rolled it out, and you know, I don't know the numbers behind it, but I guarantee it's creating a lot of value. So before, I'm going to close out with just specific actions and suggestions to upgrade your retention rates. But before I do that, I just want to, I want to hear your vision. I have a vision.
Yeah.
I'm currently writing an article called the Loan Officer 2030. How will there be less of them? Will they be doing more loans? But like, this is an article I'm working on, but I've broken it down like the path to 2030. And to me, the next milestone of, real change is going to be 2025. And then there is going to be a milestone that I'm going to write about in this article of 2027. And then I'm just going to go to 2030. But for, in the context of this conversation, how different will things be on a retention level? And I want you to answer it in two silos, in 25 and 30. What are your thoughts?
Let's start with 2030 because it's more fun.
Yeah, go for it.
Expansively. So I think one thing that I found interesting in looking at historical turnover and refi retention data is that a few years post Great Financial Crisis, so 2011, 2012, refi retention skyrocketed. People are retaining refi in like the 60 to 70% range. And, I'd love to hear your takeaway from those two data points. The best thing I can come up with is that, that the industry came a lot less competitive in the years after the financial crisis.
Mm-hmm.
Right now, what we're going through now is not that, but we are kind of over time seeing things normalize. Loan officers leaving the industry. I think we went from about 130,000 loan officers at the end of the end of 21, and we're now down to about 90,000. And that's active loan officers, those who are producing at least one loan a quarter. So that excludes the noise of the people who aren't producing. And so I do think as the industry, knock on wood, hopefully stabilizes, you should see kind of a spike in refi retention. Just given, a lot of the people who are in it for the easy money during 2020 and 2021, that noise has calmed down. In terms of purchase retention, I mean, I don't have enough data to like pinpoint that trend there. Just given what I only have information from a few companies, and I think it's way underreported on. But I think so much of it from a lending company perspective, right? If I'm running a mortgage business, so much of it hinges on my ability to retain loan officers. And if I look at the last 20 years, it's hard to predict that trend is going to change. Although I hope it does, right? Because I think people who can retain their lenders and create a consistent experience over time can create a really powerful combination for consumers and those who really want kind of long-term advocacy.
I don't know if you've done this. We're doing case studies right now. And, we have always traditionally drilled down on what is the conversion, of the, application to closing. How do we help? From a price exception standpoint, like how much more profitable are they? And then from a retention, like what is the retention increase? And those have always been our three kind of key data points that when we do a case study. But we recently came across a case study, and it may be out when we publish this. I don't know, from the time you and I record this till the time it hits our channel. I'll try to get it out, but it is stunning. I'm not going to say the number because we haven't, we had a first call where they said it was a bit, but by the way, it was a stunning success. And that the loan officers within this company, they looked at their retention and the loan officers that they lost, the ones that used Mortgage Coach, they had adopted it. They used Mortgage Coach. One were, I think it was like 8.9, almost 9% higher conversion, 6 basis points more profitable in this one.
Wow.
And literally the retention of the loan officers that use Mortgage Coach, like they didn't leave. It was insane.
That's awesome.
And I would be willing to bet that when you guys, and by the way, have you done it where you looked at a company and they looked at the LO retention for the, clients you have where they used Homebot, like they work at this company, they use Homebot, and what the retention is versus if they don't use it. Have you looked at that?
We have, and it's kind of hard to parse out correlation versus causation, because I think, call it the middle to top producers tend to be, the best kind of, highest users of Homebot. So I think when you break down loan officer turnover, that 38% includes both voluntary departures and involuntary departures.
Right.
So, I think what you're really trying to prevent is one of your top producers or middle producers or up and comers from going to a competitor. But you're always going to see, that kind of bottom 10 to 15% leave the industry. So I think, Dave, like the best way to improve your loan officer retention rate is to focus, every ounce of yourself on making them successful.
Well, that's it. Well, by the way, that's part of my thesis as to why the users of Mortgage Coach aren't leaving, is they're successful. And they're also reliant upon the company's tech stack to drive that success. So they, company has this great tech, the loan officer uses it, the loan officer is successful.
Yeah.
They're not as likely to be looking for a new gig as people that aren't. And, So let's get into, and, we've only got a few minutes left, but let's just, riddle off some actions. We're getting a coaching session from the CEO of Homebot, and you've got a lot of C-suites that you surf in and out of. You have a lot of loan officers that use your tech for retention. What are some actions people should take after hearing this?
So to recap, kind of the best practices, right? It's back to the basics, right? Start if you're not measuring it, or if you don't have full alignment around the metric, right? Like start there. What gets measured gets managed. So I think from a retention perspective, measure it, maniacally, and break it out by refi, by purchase, and by business segment, right? CDL, distributed retail, servicing. And I know there's some overlap there. But I think, in order for people to focus on it, it should be something that individuals are focused on as well. Because for the same reason as to why it matters for a lending company, matters for an individual. And I think I want to go back to something I said early on, which focusing on retention doesn't just have a long-term payoff. I think those who are focused on providing a best-in-class consumer experience and advice over time are going to unlock so much more new acquisition, right? Because they're building their reputation, and they're going to create a whole lot more referral business for themselves. And that's true for individuals. And I think that should be something that, company leadership really harps. And then the third was, be disciplined about maintaining relationships and use technology to help you do that at scale. And the last one is have a learner mentality and be really curious. And when someone does transact with another lender, pick up the phone and ask them why. And I think people are always willing to give feedback when you're coming from a place of genuine interest and you're looking to make, your offering and your brand and your business stronger. And you're asking for somebody's opinion.
Love that. So before I share my closing, actions and thoughts, and I am going to let you have a closing word. So be ready for that.
That was my closing word, Dave. I'm good.
Well, no, you're going to be ready for one more. So, first of all, my answer for the industry in 2030 and 2025 is that conversion rates will continue to improve. Retention will continue to improve because the haves, there'll be companies, and we're moving into this era now of the haves and the have-nots, and the haves have great tech stacks, and the haves do have TrustEngine. And I know, you have a roadmap that creates retention, and I know the way we're taking data and turning it into dollars, like it's going to change the industry. So with that said, my actions for everyone, and I'm going to assume, like when I speak to you, I'm going to speak to you as though you're an executive, but loan officers, you can put this into your own action. It is time to really get good at delivering advice at scale. 63% of all loans in America are, 2% or 3%. Another 20% is at 4%. So that means 83% of every loan in America, starts with 2, 3, or 4. Like real estate agents have never dealt with that before. Still the amount of millennials that haven't buy that want to buy, and Gen Z is coming. And trust me, guys, they want a tech-enabled advice experience. So train on being an advisor. So for all you executives, like having our technology is not a competitive advantage. Having a sales force that's trained at scale, that is using our tech, that is delivering advice and not price, guys, that's a competitive advantage. And so, I recently have been doing a lot of interviews on our Tuesday and Friday interview that I'm calling speed to need sales training, where we're training on how to go from a loan officer conversation into needs, strategies, solutions, build wealth, let me manage your mortgage over time. Like the companies that do that are going to win. So first of all, if you aren't using Homebot, we'll put a link down below, get a demo of that. There'll be a link down below for a demo of TrustEngine. But I'd also push, and Charlie, I hope I'm not stepping out of bounds here, like it's relaunch time. Like if you have one of our platforms, it's time to relaunch that platform, because the way that we bring value in this market is evolving. Like we're working really hard to build a data advice platform that helps in a purchase market. And I know Charlie and the Homebot team are doing the same. So either get a demo, relaunch. And then my last piece of advice is I see like success stories popping up all the time. And sometimes that success story pops up and a manager forwards it to me. And I'm kind of like, what is this? And then I got to scroll through the email to like figure it out. Like, oh, there's the gold, like if you're a leader or a manager, like get success from the trenches and then package it in a way that's super easy to understand and see. And that's how you change behavior, where it doesn't happen from just rolling out our tech. It happens because you rolled out our tech, you did it well. When you got success stories, you shared them thoughtfully. You're doing, bi-monthly, quarterly, masterminds where your loan officers are teaching and training other loan officers, and you're doing it consistently. And it doesn't happen in a quarter. It doesn't even happen a year, but like a couple of years later, you've got this, retention engine, mortgage organization. And so those were my last thoughts. Anything you want to close out with, Charlie?
No, that's so spot on. I think it takes so much over communication to get people to build new habits.
Yeah.
Right? Kind of a rollout and then back to normal, you're going to miss the boat. So I think, to your point, highlighting those individual success stories are so important, and people relate to good stories. And, one of those I would like to share, just to kind of wrap this thought, because a lot of what I've said has been kind of speaking in the abstract. But, a few weeks ago, I heard from a lender whose consumer went into Homebot, who had student debt, credit card debt, and a mortgage with, I think, about an 8% rate. Credit card debt and student debt were in the teens. She saw Homebot with just some very high level awareness about how to tap into the power of that equity, called the loan officer. Loan officer was able to, erase some really high interest debt, save her $500 a month. Those are the stories that really motivate me, and I think motivate a lot of loan officers out there, which is doing some good in the world. And those are really meaningful loans that they can be doing. And in this market, highlighting those makes a big difference, because I think it fuels all of us. So also just knowing the impact we're having, not just on somebody with high interest debt, but a first-time homeowner, and really, really helping them simplify a very complex process.
Yeah, no, well said. I'm going to close out with a little story, just because this just hit our Facebook group a few hours ago. And it was shared by Denise Donahue. I imagine she's a great Homebot client, and, one of America's most successful, but she had a review, and I'm going to read the review from a borrower. Denise took a very hands-on approach with us and provided us with a personalized video session, explanations that gave us a different perspective on our loan. By the way, Mortgage Coach does that. So does Homebot. Different perspective, not just, here's your rate, here's your fee, like everyone else. Definitely felt like she was putting us in a position of managing our money other than managing us. Much appreciated. So guys, that's it. And it's something that both of our platforms do a really good job. They give consumers a different perspective on how they can build wealth. And they give the feeling that, you care about me on a hyper personal, hyper local way. So Charlie, I love innovating with you and the whole Homebot team. I've got to introduce you to our CEO, Rich Harris, and our head of product, Rich LaBarca. I would love to continue to evolve our partnership, and really thank you for making time to bring advice into this community of ours.
I appreciate it. Thanks for having me. And just want to say how much I appreciate content you put out there. I've learned a lot throughout, the last few years of my run at Homebot from you and the guests that you bring on the shows. And last comment, I swear, is that, I think in terms of kind of talking about retention impact and being curious, right? Like, I want to eat my own dog food. And I'm sure I said a few things that people will object to, just in terms of how I'm thinking about the data, and would love to use this as a chance to be challenged and pushed and refine how I'm thinking about these trends.
Love that challenge. Love how humble you are. Anyone watching this, hopefully you got value from this. Make sure you like the TrustEngine YouTube channel. That is innovation for lenders. And we have a mortgage coach YouTube channel, which is best practices for loan officers. Make sure you follow the Homebot crew. If you're not using it, you should be. If you don't know what it is, come on, get a demo, get out there, and hope you got value. Take care, everybody. This is a wrap.